Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Financial Statement Analysis, a complete guide. Net profit margin. This ratio measures how much profit remains from total revenue after all expenses. Formula. Net profit margin equals net income, total revenue, x 100. Key takeaway. A higher margin means the company keeps more from every dollar earned. Think of it as an efficiency score for turning sales into profit. Leverage ratios. Leverage ratios assess how much debt a company uses in its financial structure. They underline potential risks and the ability to manage obligations. Debt to equity ratio. This ratio compares total debt to shareholders' equity, showing how much of the company is financed through borrowing versus owner investments. Formula. Debt to equity equals total debt, shareholders' equity. Why it matters. A ratio below 1 suggests the company relies more on equity than debt, reducing financial risk. A higher ratio indicates greater reliance on debt, which can increase risk if cash flows can't cover repayments. Interest coverage ratio. The interest coverage ratio reveals a company's ability to cover interest expenses with earnings before interest and taxes, EBIT. Formula. Interest coverage equals EBIT, interest expenses. Interpretation. A ratio above 2 is generally considered safe, meaning earnings comfortably cover interest payments. A lower ratio signals potential strain in meeting debt obligations. Understanding these ratios empowers stakeholders to ask the right questions. Is the business stable in the short term? Is it making enough profit? Can it handle its debt? These metrics cut through the noise, offering clear indicators of financial health. Trend analysis. Trend analysis is a powerful tool for understanding a company's financial performance over time. By examining how key financial metrics change across multiple periods, you can spot patterns that reveal strengths, weaknesses, and growth opportunities. It helps businesses and investors answer critical questions. Is revenue steadily increasing? Are expenses growing too fast? Is profitability improving? Let's break it down. Horizontal analysis. Explain horizontal analysis and how it is used. Horizontal analysis, also called trend analysis, compares financial data over a specific period to identify growth or decline. It's like looking at a time-lapse photo of a company's financial health. By evaluating changes year over year or quarter over quarter, you can track shifts in revenue, expenses, and profits. Here's how it works. Choose a base year. Select a starting point, like the previous year. Measure percentage changes. Compare each financial item, like sales or net income, in subsequent years to the base year. Spot trends. Are revenues climbing? Are expenses outpacing sales growth? Trends often tell a bigger story than standalone numbers. For example, let's say a company's revenue grew by 10% in year 2 and 15% in year 3, but its expenses rose by 20% each year. That gap signals potential trouble. Higher costs could hurt profitability long term. Businesses use horizontal analysis to forecast future performance. Investors rely on it to evaluate consistency and predictability. If revenue follows an upward trend and expenses stay under control, it's a sign of strong financial management. However, any negative trends, such as declining net income or climbing debt, might indicate emerging problems. Vertical analysis. Define vertical analysis and its applications in financial analysis. Vertical analysis, on the other hand, takes a slice of the pie perspective. Instead of comparing across time, it examines the proportional makeup of a single financial statement. This method expresses individual items as a percentage of a total, giving clear insight into resource allocation or spending priorities. Here's how it's applied. Income statement. Revenue is set at 100%, and other items, like expenses or net income, are expressed as a percentage of revenue. For example, if operating expenses are 40% of revenue, it shows how much of the company's earnings are consumed by day-to-day operations. Balance sheet. Total assets are set at 100%, and individual components, like cash or accounts receivable, are broken down into percentages of the whole. If inventory equals 25% of total assets, it reveals how much the company has tied up in unsold goods. Vertical analysis makes it easy to see changes in the structure of a company's finances. For instance, is the percentage of cost of goods sold, COGS, shrinking relative to revenue? That's a good sign. Profit margins are improving. Conversely, if administrative expenses take up a growing slice of revenue, it raises red flags about cost efficiency. This approach is especially useful for benchmarking against industry peers. By comparing percentage metrics like COGS or gross profit margin, you can see how well your company stacks up. For investors, this analysis highlights potential inefficiencies or opportunities for improvement. Both horizontal and vertical analysis are crucial for evaluating performance. Together, they provide a complete picture of trends and financial structure, helping you make data-driven decisions with confidence. Common size financial statements. Common size financial statements simplify financial analysis, making it easier to compare companies of different sizes. By expressing each line item as a percentage of a total, they allow for clear, side-by-side comparisons. Whether you're assessing performance over time or benchmarking against competitors, common size statements offer valuable insights into financial trends and priorities. Creating common size statements. Creating common size financial statements involves converting standard reports into percentages. Here's how you can do it for the two most common financial statements. Income statement. Start with total revenue as the base, 100%. Express every line item, like cost of goods sold, gross profit, or operating expenses, as a percentage of total revenue. For example, if revenue is $1,000 and operating expenses are $200, operating expenses would be 20% of revenue. Balance sheet. Use total assets or total liabilities and equity as the base, 100%. Calculate each line item as a percentage of this total. For instance, if total assets are $500 and cash is $50, cash would represent 10% of total assets. This process requires simple math and can be done using a calculator or spreadsheet. Once converted, these statements focus on proportions rather than absolute values, making trends or anomalies pop out immediately. Benefits of common size analysis. Why bother with common size financial statements? They unlock key advantages for financial analysis, especially when comparing companies or tracking internal performance. Easier comparisons across companies. Companies differ in size, so raw numbers can be misleading. Percentages tell a clearer story. For example, a small business with 25% profit margins might outperform a large corporation with 15% margins, even if the total profits differ. By focusing on percentages, common size analysis levels the playing field, making it easy to see how companies allocate resources or control costs. Spot trends over time. Common size statements help identify shifts in financial priorities or performance. Is the company spending more on marketing over the years? Are operating costs eating into revenue growth? Analyzing percentages reveals subtle changes that might go unnoticed in raw numbers. Better benchmarking against industry averages. Comparing a company's percentages to industry norms highlights strengths and weaknesses. For example, if a retailer's inventory as a percentage of assets is much higher than the industry average, it could suggest overstocking or inefficiency. This insight helps businesses improve performance and stay competitive. Simplifies complex financial data. Looking at percentages makes financial statements more digestible. You don't need to memorize every dollar amount, instead, you focus on proportional changes. Common size financial statements are like a magnifying glass for financial analysis. They transform an overwhelming pile of numbers into a clear, actionable view of financial health and priorities. Whether you're an investor, manager, or creditor, this tool makes financial data work for you. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.